Hey, Dan Fitzpatrick here, and I want to look at some of my favorite bullish patterns. I love buying stocks when they're going up. I love buying them more when they're about to go up, and then they do. So my favorite one is volatility squeezes, and here are the parameters. Okay, we want low volatility, and that means rather than prices trading like this, instead they're trading like that. This has nothing to do with implied volatility in options. That's for another time. But what I'm talking about is a stock that's trading in a really narrow range here, okay, like Netflix was prior to earnings. And let's just get tight consolidation. I use Bollinger Bands. They are 2 standard deviations, typically above and below the 20-period moving average, 20-day moving average, and it's a simple moving average because these Bollinger Bands contain the price. With 2 standard deviations, the close should be within the Bollinger Bands about 91% of the time. In other words, 9 days out of 10, the stock is going to close within these Bollinger Bands. Well, the thing is, when the price starts to expand, when it starts to break out one way or another, just because of the way standard deviation is calculated, these bands explode. They really start, like, just focus on the bands here, not on the price, though you can see what happens to the price. These bands were fairly tight, and then when the stock started to move up, the Bollinger Bands expanded, okay? And they're always going to be equidistant from the moving average that they're based on. And here, that's the 20-period moving average. So when the 20-period moving average, this is really a good way to think about it, okay? When the 20-period moving average is moving sideways, typically, and the price has been moving sideways for a while, by the time the 20-day moving average starts moving sideways, these bands are going to be really narrow. And what that does is, and this is important, so pay attention, I'm giving you pearls here. What that does is it sets up the conditions where a stock can move outside of the Bollinger Bands and keep going. Now, we don't know which direction the stock is going to move. We can make an assessment based on, hey, the trend, based on the fact that the stock is trading above the 200 and the 50-day moving average. We can make that type of a technical assessment, but really you don't know for sure. It can go either way. Now, let's look at a couple of these other parameters. Okay, we want this trading on low volume. Okay, Netflix had been trading on fairly low volume after this big move here. I'm not going to analyze Netflix too much. We want the proximity to moving averages to be tight. In other words, we want the price to be very close to these moving averages. Now, if Netflix was this close to the 50-day moving average and this close to the 200-day moving average, that would set up a very, very explosive move. You're going to look and see what happened back here. Again, these bands fairly tight, but look how close the price was to the 200 and the 50-day moving average. Why is this important? It's important because the moving average is literally the current value of the last 50 days of prices, the last 200 days of prices, the last 20 days of prices. And so what this means is the average cost basis of traders, short-term traders, right around where the 20-day moving average is. Intermediate-term traders, right around the 50. Longer-term traders, they're going to be focused more on the 200-day moving average. So we like to see these really, really close together. Here, Netflix wasn't so close to the 200-day moving average, but look what happens from this squeeze. Okay, we get a breakout. Ultimately, stock splits 7-for-1. They also report good earnings when? Here. So this was the big move. Now, do you see what I mean? Tight Bollinger Bands, a little pullback. Here's another thing I want to point out to you. I have a 3-part way to analyze volatility squeezes, and it's not a formula. It's just my way of looking at it, kind of like I tend to look at IPOs in a certain way that makes sense to me. So here we have the squeeze. Now what we're looking for is a breakout, kind of like we got here, right? Okay, so there's almost the breakout. That's the breakout. This is phase 1, the initial breakout. Then phase 2, what I'm looking for is an end, a pause, whatever, in the initial move. And then after that, phase 2 starts when the stock starts to pull back. Ideally, if this is a squeeze to be believed in, I don't want the stock to pull back further than this 20-day moving average. Basically, I don't want it to fall too much into this prior congestion here. Why? This is important. The reason why is because if the stock falls back through here, this tells you that there's not a lot of buying interest. So this was kind of a fake out here, this initial move. But on the other hand, if the stock falls back to here, or not even this far back, and then starts moving higher again, what this tells you is that folks were kind of lulled into complacency. There were a lot of traders left behind that didn't buy, so now they get a second bite at the apple when the stock moves back. So that's phase 2, the pullback, and it needs to stay above this level. And then finally, phase 3 really is the stock's challenge of this prior high, this prior phase 1 high, the stock's challenge of that, and then if it breaks out, that's a continuation pattern. So we can see what happened in Netflix, and I'm going to show you some other things here, some older ones here in a second. But you can see, so this is, maybe the end of phase 1, just a little breakout, and that's fine. Okay, phase 2, 7 for 1. We're right here. What we need to see is the stock turning around, and then boom, the next day it's off to the races. So this is phase 1, phase 2, and then phase 3. Now, it extended so far up that you have to look at this and say it can't go up forever. But frankly, because the stock was drifting sideways for so long, the average cost basis of short-term traders was right around this level. That's the reason why Netflix was able to move up so high, and then finally, as usually happens, this type of a move ends badly for traders because they get too lathered up. Now, let's look at another one. This is not really a volatility squeeze. Apple. Okay. This is what I'm talking about. This, again, is not really a volatility squeeze. I want to see these Bollinger Bands really, really tight. The reason, though, that I was looking at this pre-earnings, and my sense was that this kind of move, again, prior to earnings, this kind of move, there was already a lot of aggressive buying that pushed the stock over 10%. That kind of buying was not there in Netflix. See, Netflix hadn't made a big move, whereas Apple did. So this was not a volatility squeeze. And then you know what Apple did, after that. Ultimately, they reported earnings. The market didn't like them. And then, it's doing what it's doing. The point is the differentiation between a volatility squeeze and just a basic move from below the lower band to above the upper band. The bigger the distance between the bands, the more buying power, the more aggressive buying it takes to push the stock from one level or one band to the other. And there's only so much buying that can take place that pushes a stock higher before finally those potential buyers have already bought, and then what are they? Sellers. So we got a lot of buying pressure pushing this stock up here, and then ultimately the catalyst was sell on the news, and most of this gain was given back. Netflix, on the other hand, not a lot of buying pressure. A lot of folks were just waiting around wondering what the heck is going to happen when the company reports earnings. The typical technical analysis approach to this would be, hey, uptrend very strong, tight sideways consolidation, you have to expect the move to be higher. You can look at Amazon. You know what day I'm doing this video. Amazon, tight volatility squeeze. Okay, we get a little breakout here, not too much. And by the way, when is this? This is June 23rd, 2015. Earnings are kind of right around the corner, so you're not seeing a lot of buying. You're seeing a little peak here, but this would not be a stock that I would think, oh, there's a lot of aggressive buying before earnings. Not necessarily. Okay, so stock drifts around, and then finally, still tight, still tight. There's the breakout, and then boom. And you think about this now. Stock has already made this kind of move, over 13% from bottom to top. This is the opposite of what happened with Apple after the open. Here, the stock had a continuation pattern. Okay, up 13, 14%, and then boom, up another 17%. So this stock was up almost, basically a third. It ramped up by a third from this last tag of the 50-day moving average before or after earnings were reported. So this was just a classic sell. And we were all over that in Stock Market Mentor forum and Option Market Mentor too. This was really obvious. But if we go back to Apple and you look, Apple had this big move. Earnings were a disappointment as opposed to a thrill. And what happens? The stock gaps down and then moves up, as opposed to here, the stock gaps up and then moves down. Let's look at a couple others, and then I'm going to let you go. So we've got these as the parameters for our volatility squeeze. So here's one quite a while ago. Textbook volatility squeeze in Vector Group. Very, very tight consolidation and a move higher. We want to see the stock moving above the Bollinger Bands, boom. And then we also want to see an increase in volume. It's not shown here. Similarly, on Priceline, way back in the day, you can see, look at the distance between these Bollinger Bands when the stock gets really wide, when the volatility is really, really high, like from here to here. Because remember, this 20-day moving average is the average of the last 20 days of prices. So it takes a while. It takes sideways consolidation for a while, like, oh, I know, about 20 days-ish, something like that, before these bands get really tight again. And then the stock's off to the races once again. So we'll look at a few more. Volatility squeeze, MasterCard. Okay, you can see what's happening here. Again, big move up and then a sideways drift. Bollinger Bands are very tight. You would tend to think that the next move is going to be up. Honestly, I don't know which way the stock went. This was a while ago, and I'm just doing this video because I want to show you what the setups are like. Stuff is not tradable. It happened years ago. And then Visa. Same deal. You look at this volatility squeeze, sideways consolidation, close to the 50-day moving average. I call this a touch and go, where the stock's in an uptrend. It's kind of like an airplane, hence touch and go. A drift sideways to down to the 50-day moving average, and then we're off to the races again, sideways consolidation, and then we're looking for the breakout here. We'll just look at one more. Skilled Healthcare, old stock that I used to follow. Sideways consolidation, breakout, and you can see this was not quite as tight, but close enough, and then you see a breakout again. The bottom line is this. You want these stocks as close to the 50 and the 200-day moving average as you can. Those are the ones that tend to have the most potential. Why? Because they're, by definition, they're consolidating, hence the volatility squeeze. They're not overbought and they're not oversold because they are in a close proximity to all the different moving averages. So I want you to use volatility squeezes as setups. These can be really bullish patterns. The one thing I will say to make it a bullish pattern is this. Stock's got to be in an uptrend. I just look at volatility squeezes as continuation patterns. At some point, they're not. The stock's going to reverse, but typically, and listen to me, I'm giving you pearls, not out of a volatility squeeze. That's not typically a stock that reverses. And by the way, if I haven't explained it to you already, when I say I'm giving you pearls, those are, quote, pearls of wisdom, but that's a line that I stole from Al Pacino, Scent of a Woman, when he was telling the young kid that he was with all of his wisdom about women. I'm just sharing with you some of this, the knowledge that I've gained through about 20 years of trading. So I hope this helps, and I hope you are enjoying your subscription to Stock Market Mentor.